Meeting. Yeah, and first of all, we will do a brief introduction on the same, a brief introduction on capital budgeting. Then afterwards, we are going to do some calculation, and yeah, it's where we are going to tackle the. Yeah, we are going to look at the net present value, average rate of return, internal rate of return. Yeah, those are the aspects we are going to be looking at under this topic. Capital budgeting, because at the end of this session, sorry, not this session, but this topic, we first supposed to understand the nature, importance, characteristics, and various types of capital investments that we have. Then we will look at the various investment appraisal techniques. That is the main aspect that we're supposed to understand under capital budgeting. You need to know how to calculate the average rate of return or the accounting rate of return. Secondly, you need to know how to understand to calculate the payback period, then the net present value, internal rate of return, and finally the profitability index. Those are the main calculation parts that you're going to tackle under capital budgeting. Then from that, now after that, we will now look at the strengths and the weaknesses of the investment appraisal techniques. How advantageous or disadvantageous is ARR, the accounting rate of return? What are the advantages and the disadvantages of internal rate of return? So we'll do the same for profitability index. We do the same for net present value, all the capital, the investment appraisal techniques that you'll be looking at. Is that okay? Okay. So first of all, you're going to be I'll give an introduction. Yeah, we'll do a brief introduction. Then today we are going to discuss. So first of all, you will have to understand what capital budgeting is. After understanding what capital budgeting is, we will look at the steps or the considerations related to capital investment decisions. When I say capital investment decision, this is the same as talking of capital budgeting. So another name for capital budgeting is the capital investment decisions. So this is what we are looking at. Capital investment decision, this is another name for capital budgeting. So we are going to understand what capital budgeting is. Yeah, in case you can't hear me, just let me know. In case you're not seeing or any questions, just let me know. So first of all, we look at what capital investment is. Then we'll go ahead and look at the key steps of the considerations that are related to capital investment decisions. Capital investment decision, this is what entails capital budgeting. Then from there, we look at the importances of capital investment decisions, its characteristics. We're just going to look at this briefly because our main focus is on the investment appraisal techniques. How to calculate these techniques, the ARR, IRR, profitability index, net present value, and the payback period. So first of all, when you're told to look to discuss what capital investment decisions are, when asked what capital investment decision are or what is capital budgeting, we can say that capital budgeting is also known as capital investment decisions, or in some other cases it's considered as investment appraisal. So when you're told to discuss the various capital investment decisions techniques, is the same as looking at investment, is same as considering or looking at the various techniques of investment appraisal. So investment appraisal is another name for capital investment decision, which is also the other name of capital budgeting. So capital budgeting can also be known as capital investment decision. So in case you come across this word, let me hope it cannot challenge you, because this is one and the same thing. We are told that, yeah, you're doing a capital budgeting, you're budgeting for your capital, meaning that you are going to do an analysis. It's the process where you're going to analyze Yeah, is the process of planning. You are analyzing your investment, the investment you want to venture in. Yeah, so it's the process of planning. To analyze, first of all, you plan, you evaluate and select the long-term investment project or expenditure that relates to the cash that you have, or the investment amount that you want to use or to employ in the specific investment strategy that you want to employ or to focus on. So when you're asked on what capital budgeting is, this one you can simply say that it's the process where you plan, evaluate and select the long-term project or the long-term investment project, the long-term investment that is viable to the capital that you want to invest with. So it's the process of planning. This is where you plan. Yeah, it's the process where you plan, evaluate, and finally select. And you have to select the long-term investment. So it's the process of planning, evaluating, and selecting a long-term investment project or an expenditure. A long-term investment or an expenditure. Financial management process, it's a crucial, this capital budgeting is a crucial process in financial management because it will help the organization, yeah, decide how it can allocate its scarce resources, for instance, for capital expenditure, in a way that it will help this organization to maximize its profits or the value that is generated from this investment. So capital budgeting is a very crucial step, or is important to the financial managers, because it helps them decide, yeah, which is the best way to allocate the financial resources that it has. It's limited financial resources, such that it can suit or it can sustain the entire project, and finally help them in maximizing the value. Yeah, and this value can be in terms of maybe its profits, so maximizing its profitability, for instance, yeah, the value of this investment. And that's why you can say capital investment decision or capital budgeting is a very important function for, or a very important process for, in financial managers. And under capital budgeting, we can now look at the key steps. Now we can look at the key steps. The key steps or considerations. The key steps or considerations that relate, yeah, related to capital, related to capital decisions, capital investment decisions. What are the key steps or considerations that are related to this? What are the various aspects that you should consider when looking at capital budgeting? The first key aspect that you can consider, first of all, you'll have to do a project. The first step, yeah, that relates to capital budgeting, you first do a project identification. And here is where you do identification. This is the stage. This is the stage where you'll define or you'll identify the specific project that you plan to venture in. Yeah, it's a step where you identify the potential investment. Which specific investment do you want to venture in? And that is where you do project identification. It's the step of identifying the potential investment opportunity. You identify the specific investment that you want to venture in. This can include, for instance, are you planning to invest maybe in an existing project? Do you want to expand this project? Or are you planning to launch a new product within maybe your company? That is a project on its own. For you to come up with a new product, for instance, you maybe assess its marketability, its viability, and finally you launch this project. Or this product, sorry, it's a project on its own. So you identify the specific project that you want to venture in. After project identification, now you'll do the project evaluation. Project evaluation. You are evaluating the project. You've identified the specific projects that you want to venture in. Yeah. Now you'll have to evaluate. Suppose I want to choose this project. Which costs am I going to incur? Yeah. What benefits are associated with this specific investment that I want to venture in? So after you identify the specific project that you want to venture in, and here maybe you'll outline the various examples or the various possible projects that you want to venture in. Now here at evaluation stage or at an evaluation step is where now you look at, maybe for instance, if here maybe you mentioned 3 projects. Now what is the cost of running this project to its sustainability, to achieve whatever I want? What cost will I incur? What will be the benefits of this project, of this specific project that I want to venture in? Yeah, you'll have to highlight the various aspects of each project. And once you've identified or highlighted this specific, once you've identified or evaluated this specific aspect, that is what we consider as project evaluation. You evaluate the costs, for instance, of this project, the various benefits associated with the project, the expected outcomes, and even the risk. What risks am I associated with for me to run this project? What risks am I able or am I capable to encounter through this specific project that I want to venture in? Once you do a project evaluation, now you will evaluate the cash flow analysis. You'll do a cash flow. Now, after a project evaluation, you do a cash flow analysis. For cash flow analysis, we are told that this is where, or this is the step that will involve, for instance, estimating the expected cash flow associated with the investment. You predicting the future revenues, yeah, the expenses, the related cash flows or other outflows of the project's life. So you do a cash flow analysis. The potential profitability of this project. What are the future cash flows of this specific investment that I want to venture in? Yeah, here at project evaluation is where, first of all, you've identified the project, the specific project that you want to venture in. Maybe you've identified, for instance, you want to launch a new product. Yeah, you want to launch a new product maybe for your organization. Now you'll have to evaluate, for instance, there's a new product that you want to bring in your organization. You've identified that is the project you want to venture in. Now at project evaluation, now what is the cost of launching this project? What is the cost of coming up with this new product that you want to, or the investment that you want to venture in? What are the benefits that will come together with the new product that you want to venture in? So at project evaluation is where you evaluate the cost of maybe starting up, the cost of starting up the project, the benefits that will be associated with this project, even the expected outcomes. What outcomes will be related to the specific, maybe the product that you want to launch? How will it be advantageous? Those are the benefits. What outcomes are related with it, expected outcomes, and even the risks associated with this project. Are we clear? Did I answer your question? Okay, thank you. Now, after you do a project evaluation. Now we've said that to do a cash flow analysis, you estimate the expected cash flow that are associated with the project or the investment that you want to venture in. This might include, for instance, predicting the future events. What future events or future cash flows are associated with the project that you want to launch? How will it be? Maybe how will it be? For instance, can we say that this project, maybe during the first year, it can give us maybe a profit, the cash flow or the cash inflow of the product, maybe it will be at 50,000. And maybe after 2 or in the next year, maybe this cash flow might increase to even 100,000. But in some cases, this cash flow can even go beyond. Maybe the first year you get a 50, coming year you get a 12,000. So no wonder you have to do a cash flow analysis for you to be able to predict whatever might happen in future. Now, after the cash flow analysis, now you'll go for capital budgeting technique. The capital budgeting technique. Here is where you identify, are you going to go with the accounting rate of return? Are you going to go with the payback period, the capital budgeting, the technique? For instance, if you go with the payback period, yeah, if we choose, for instance, the payback period technique, how long, for instance, if you take up a loan from a company to start or to launch this new product, you've done a project evaluation, you know the cost that you need to run this project to its completion. Now, you identify, for instance, you need 1 million, and you don't have this 1 million. You decide, let me go to the bank and take this 1 million. And you decide you'll go with capital budgeting technique for it to help you pay back this amount, the 1 million. You should be able to evaluate how long you've assessed the project that you want to venture in. Now you'll have to evaluate how long will it take me for me to be able to repay back the 1 million that I took from the bank. Now that's what you'll do under capital budgeting technique, the amount that you want, how long will it take you maybe to repay it, and that is what you do at capital budgeting technique. After that, now you'll do the risk analysis. For you to venture in any investment, there are various risks that are associated with it. Now you'll do a risk analysis. You do a risk analysis. At risk analysis, capital investment decisions should be able to incorporate a risk analysis. This one will help it assess the uncertainties that are associated with the cash flow estimates. Here, remember here you did a cash flow analysis. You've evaluated maybe how this project will be able to repay back, the cash flows that might be associated or might be linked to this project. Now when you do a risk analysis, you're going to assess the uncertainties that are associated. Like here, why is it that during the first year you get a 50,000 cash flow, but when it comes to the second year we have a 12%? Those are some of the various aspects that you'll discuss or you'll review under risk analysis. Now after you do a risk analysis, now you'll have to select and rank. Now you do a selection and ranking. Selection. Yeah, you do a selection and ranking. Remember, at the project identification, we say that you will state or you will note down various projects that you might venture in, depending on the capital that you have. For instance, you want to launch a new product, or you want to expand your organization. So for all these aspects that you've identified, you'll do all these steps for this product. Now after you've done your risk analysis, you'll do a selection of the most viable project that now you're going to focus in. So at the selection stage, here we told that you do a selection and ranking. Ranking, for instance, you say, if I venture into expanding my organization, this one will be the best. For instance, it can give me, if it gives me a 30% profit, while on the other hand, the new product gives me a 20%. Now, if we go by ranking them, meaning expanding my organization is the best investment that I should go by. So I can go by ranking. This will be my first priority. Then the new product will be my second priority. And once you've ranked, meaning that you'll go with your first, the most viable project, which will be expanding my organization. And now so here, remember, we've done a ranking, we've identified the ranks, and now we do a selection of the most viable, which you go by the first one. We will choose maybe expanding our organization. Now after selection and ranking, now we do a decision and implementation. This is basically implementation. Implementation is where you put now the project into action. You've identified that now through whatever I want to do, I want to invest by expanding my organization. That is the selection you made. Now you just don't select and sit back. Once you select it, now you have to put your selection into action. Now you have to come back to the field and do exactly what you've evaluated. You've decided you're going to venture into a new product. Now put that act into action. So that is what you do at implementation. And after implementation, we have the post-implementation stage that is known as monitoring, control, and evaluation. You monitor, control, and evaluate. It's known as the post-implementation. Are you able to see my board? We're talking of post-implementation. Post-implementation. Yeah, post-implementation. This is where you're going to do a review. And for you to do a review, this means that you're monitoring, evaluating, and controlling now the project that you've ventured in. Are you achieving the goals that you identified the project will be able to provide to you? Yeah. And in case you're not achieving this, then you'll have to do another risk analysis. You'll have to redo the entire session for you to identify where the mistakes or the gaps are, or why are you compare the actual outcome of your project and what was the expected of you. What did you expect the project will provide you with? And that is what a post-implementation stage or step helps us to understand. Any question on the steps or consideration related to capital, or are we clear on that? For us, we can continue. Can we continue? We've looked at what capital budgeting is, and now we've looked at the key steps or considerations related to capital. I guess there's no question. Now from there, we look at the importances of capital investment decision, the importance of capital budgeting. Looking at now the importance is how important is capital budgeting. So we are looking at the importance. This ones you're going to pass through. The first importance we can talk of, we can say that capital budgeting has a long-term impact. Yeah, they have a long-term impact. So the first advantage, you can say that it has a long-term. It has a long-term impact. Here we can say that the decisions that are made in capital budgeting are profound to last long and impact the financial health. You don't run a project that lasts you a month or two or even 1 year. You're running a long-term investment, something that will come back, and maybe, for instance, you're investing for investment is basically a long-term aspect. So the first importance is that it has a long-term impact. It's meant to last longer and fulfill or achieve an organization's or an individual's goals. So it has a long-term impact. That is one of the importances. You venture into investment because you want, or you have some long-term gains that you want to achieve. Secondly, we can talk of adequate it facilitates. We can talk of resource allocation. We can talk of resource allocation. Under resource allocation, we know that for a project to be ready to its completion, we have to have adequate resources to facilitate this process. Yeah. So it's important to allocate these resources effectively for us to be able to maximize return and minimize the resources. So it's important in that it makes resource allocation adequate or efficient, because you have the resources, you budget for the entire. For instance, you have 1 million. You'll have to say how much will I use in the advertisement stage? How much will I use to purchase the products that I need, the properties that will help me in achieving this product, in creating this product that I want, the materials that I'll need. So capital budgeting helps it ensures that there is adequate resource allocation for a project to run to its completion. We can also talk of risk management. It helps in risk management. Remember we say that one of the steps associated with capital budgeting is the risk analysis. You review the various risks that are associated with the project that you're venturing in, and this one will help you to come up with the strategies on how you're going to the strategies that will help you in mitigating or controlling this specific risk, such that in case this foreseeable risk, risk assessment helps you to foresee the risks that might affect the success of your project. So capital budgeting is important in, as it is another aspect of risk management. You can also talk of it has a competitive advantage. Making the right capital investment can enhance a company's competitive position. For instance, if a company wants to, maybe their project is to maybe introduce another ingredient in their existing products, they say that our product has this, and that, but I want us to add on this specific aspect. For us, for instance, if the rate of competition is quite high, there are other competitors in the market selling the same product, maybe with just a different brand name. For them to make it different from their competitors, they might discuss, let's now focus on introducing another aspect or another ingredient towards our product. Or if it's a service, maybe they decide our product, we are going to maybe have or bring in additional services for us as a promotion mechanism, so it can help or it can provide a competitive advantage. I guess there are many other importances of capital budgeting, but you can focus on those four. Then we can talk of the characteristics associated with capital budgeting. Any question? Capital budgeting characteristic. First of all, remember we just say that it's a long-term aspect. So the first characteristic or the first feature of capital budgeting, it's long-term in nature. Remember we say that you venture in an investment for a long-term gain. So it's important because it has a long-term impact, and one of its characteristics is that it has a long-term commitment. One of its characteristics, it has a long-term commitment. You can also talk of significant financial outlays. You evaluate how much is going to be spent in each stage or at each level or at each aspect that will make launching a new product effective. So it has a significant financial outlay. You evaluate. Requires a substantial amount of financial resources. You have to have a specific amount of money for you to launch a product to its completion. So the first characteristic we can talk of, we are looking at the characteristics. First of all, you say that it has a long term. We can talk of long term commitment. We have significant financial outlay. You can't venture into a project if you don't have some finances to support your project. And that's why we talk of significant financial outlay. You can't expand a business without some financial support regarding the project. So that is what we talk of, significant financial outlays. We can talk of risks and uncertainties. This is self-explanatory. You don't begin a project with 100% assurity that your project will be successful. So it has the aspect of risk and uncertainties. We can also talk of complex evaluation. Here, I guess you will understand about the complex evaluation mostly when it comes to calculating the IRR, because there are some projects, some other capital budgeting techniques that requires you to redo the entire process for you to get to whatever you're trying to look at. So it might be complex, calculating or understanding some other capital budgeting techniques. We can also talk of It has an evaluation period. It has an evaluation period. Yeah, this one can be derived from the step that we say that first you identify the project and now you evaluate. And evaluating takes time. You'll have to discuss, maybe to draft the costs that are associated with your project, the benefits, the various outcomes. And for you to find the outcomes, you have to give various instances to generate, to foresee the future. Maybe you use various, maybe calculating figures for you to be able to attain the uncertainty cash flows that we don't know about. So it requires an evaluation period, because if you don't give yourself a certain period to evaluate, you just can't come up with a project today and you want to launch it tomorrow. You might get at the middle of your project and maybe you understand, or you find out that maybe there's a key aspect that you missed out, and it's because you didn't do an adequate evaluation. So for you to start a project, you need some time to evaluate how viable, how effective this project will be attainable. So it has some evaluation period. There are various characteristics, others you can look at them at your free time. Yeah, I guess that is what we can give. This is the brief introduction we can give on capital budgeting. Any question on this introductory part? This is what we can introduce on capital budgeting. Because now from there, now I want us to look at investment appraisal techniques. Any question? Any question? I guess there is none. Now from there, now I want us to look at the various investment appraisal technique. Remember I say that there are 6. Yeah, if I'm not wrong, there are 6, and they're divided into 2. We have the traditional and the modern, where one is regarded as discounted and non-discounted. So now I want us to look at investment appraisal techniques. This is our second subtopic, investment appraisal techniques. I guess here we are basically looking at the techniques of capital budgeting, and we can't give a summarized explanation of this. Instead, while we are looking at each technique, we'll be understanding what this technique deals with. So under investment appraisal techniques, you might find a question that wants you to give the features or the principles of a good investment appraisal technique. Now let us look at the features. Let us not look at the features or the principles. Let's look at the features or the principles of a good investment appraisal technique. Let us not look at the features. The first feature we can talk of consistency. There's consistency. Allow me to read. We are told that the technique should provide consistent results when applied to the same set of project data or assumption. The technique that you want to, the specific technique, for instance, you decide for this project, I'll go maybe with the payback period. Yeah. And maybe you use a certain figure or a certain data to verify how this technique will be viable to your project. Yeah, if for instance you key in a given figure, this technique should be able to be consistent in that whichever value you key in, it should be able to generate, yeah, maybe a similar feedback, even if the answers won't be the same, but maybe the relationship should be equal. So it has consistency. It should not produce highly variable outcomes with minor changes in inputs. When the inputs are changed, the differences should not be high. There shouldn't be a very huge variance on the differences in the techniques, in the various techniques. So there is consistency. Secondly, we can talk about accuracy. The technique that you decide should be accurate. So investment appraisal techniques are accurate. So we can talk of accuracy. You can look at accuracy. The technique should provide an accurate estimate of the project's financial viability and risk. It should be able to use reasonable assumptions and methods for cash flow estimation. So the technique that you use should be able to provide us with the most accurate feedback. So we can talk of accuracy. From accuracy, we can talk of relevance. It should be relevance. Yeah, the technique should consider all relevant cash flows, both inflows and the outflows, including the initial investment of the project, the operating revenues, the expenses, the salvage value, the scrapped values. Yeah, this investment technique that you consider or you choose for your project should be very much relevant. You can also talk of time value of money. You can talk of time value of money. Investment appraisal techniques should incorporate the time value of money. It should be a time value of money. This is where an investment is able to consider that, for instance, the value of $1 today, the value of $1 today won't basically be the same as the value of the same dollar when it comes to tomorrow morning. So the specific appraisal technique or investment appraisal techniques should consider time value of money. They should know that $1 or 1 shilling today has a different value. There's a different value of the same shilling tomorrow. So it should be able to incorporate this aspect of time value of money. We can also talk of risks and uncertainties. Risk and uncertainty. This I guess is a self-explanatory. You can also talk of considers all costs. It should be able to consider all the costs. Considers all costs. It should consider cash flows relating to the entire useful life cycle of lifetime of the project. If you are launching, for instance, your project, you want it to run for 10 years. It should be able, the technique that you choose for your project should be able to consider all the costs, the entire useful lifetime of the, it should include both the explicit and the implicit costs. For instance, the opportunity cost, the cost of capital associated with the project. So your investment appraisal technique should be able to consider that cost. So we are told to look at the various principles or the features of an investment appraisal technique. You can talk of consistency, accuracy, relevance, time value of money, risk and uncertainty, and finally should consider all costs associated with launching the project to its useful lifetime. Any question? None? Yeah, I guess I'll give a brief introduction here. Now I want us to look at, under the investment appraisal technique, we can say that this investment appraisal technique is basically classified into two main types. We have the modern investment appraisal and the traditional investment appraisal. And the modern investment technique is the one that is also considered as the discounted cash flow technique. For instance, you might get a question. We're looking at the classifications of investment appraisal technique. We're looking at the various classifications that we have. And we say that we have two main classifications. So we're talking of classifications. And we say that we have the traditional and we also have the modern. This traditional is also known as the non-discounted cash flow technique, while the other one is also known as the discounted. So you might find a question that asks you to calculate, maybe you use traditional methods to calculate maybe yeah, the value or the duration needed maybe to repay back a given amount. So traditional is also known as the non-discounted cash flow technique, while the modern is the discounted. So these ones are the main classifications that we have. But under each now, under the traditional, they are classified into two. There are two types. They are of two types. While for modern, we have four types. Yeah. For traditional, the traditional techniques, we can talk of the payback period, the PBP, the payback period. While there, and the other one we can talk of the ARR, accounting or the average rate of return. While for modern, we have the NPV, net present value. We can also talk of the internal rate of return. Yeah. Then I guess you can talk of profitability index. This is known as the PI. And finally, we can talk of the discounted payback period. Discounted payback period. Okay, so I want us to look at this. Today we are going to try and cover the traditional non-discounted cash flow techniques. We can look at traditional, then I bet we'll pick it up from there during our next session. But before then, can we have a break for around 5 minutes, kindly? Is that okay? Okay, just a 5 minute break, then we can pick it from there. Yeah, so I want us now to begin on working out on our calculations. We are going to start by looking at traditional or the non-discounted cash flow techniques. We're looking at the traditional or the non-discounted cash flow techniques. Here, first of all, the first technique we are going to look at, under the traditional technique, we are going to look at the payback period. This is initialized as PBP, the payback period. Payback period, this is, from what we have, it refers to the duration that is taken by a project to generate cash flow that are sufficient to recover. Yeah, payback period is basically the time that it takes for a project to recover the amount that was used in developing this project. So it refers to the duration taken by a project to generate cash flow that are sufficient to recover or to recoup, yeah, the initial outlay, the cost of the project. So the payback period is the time that it will take for a project to be able to refund the amount that was used in launching this project. So this is just basically the time. Yeah, and the payback period, for you to calculate payback period is calculated at 2 steps or in 2 scenarios. We have the first scenario where each year has an equal cash inflow. So payback period can be calculated in 2 aspects. Where we have the first part, we can calculate the payback period of a project, yeah, of a project whose cash inflow are similar. So we have payback period for a project with similar cash flows, and we have one with irregular. For instance, the first year we receive maybe a cash flow of 50,000. The second year we get another one of 80,000. The third year we have a 30,000. So that is an irregular cash flow. So that is a project that gives us an irregular cash flow. And in these 2 cases, calculating the payback period is different. Calculating a payback period for a project with a similar cash flow is different to calculating is different from calculating the payback period of another project, but a similar project, but with irregular cash flow. So I want us first to look at with a similar cash flow. Yeah, with a similar cash flow, calculating the payback period, you just take the initial outlay. You get the initial outlay. You divide by the annual, the annual cash flow. Annual cash flow. For instance, you are told that a project that requires an initial cash flow or an initial cash flow of 1 million. Yeah, for instance, our project required an initial outlay or an initial cash flow of 1 million, and once the project was developed, the annual cash flow that we had, for instance, we had an annual cash flow of 100,000, and now you want to calculate your payback period. You'll just take your 1 million, you divide by 100,000. I guess that is very simple. Yeah, you get the initial outlay, the initial cash or amount that is required to facilitate a project. Yeah, the initial amount required to facilitate the project and the annual cash flows of the project. Is that okay? And from that, I want us to do an example. This is easier. For instance, you're told the cost of an investment of a project is 37,000. Yeah, we're doing an illustration for a project with similar cash flow. For instance, you're told the cost of an investment of a project is shillings 37,000. This is the cost. The cost of a project is 37,000, and the expected annual return of 10,000 shillings per annum. annual return, we have an annual return of 10,000 return. Now you're told to determine the payback period, the time it will take to fully recover this amount. What time will it take us to fully recover this amount? And for this, we said it's just very direct. You take your annual outlay, your cost, the cost of facilitating the project to its completion, you divide by the return. And in this case, you'll just take 37,000, you divide by 10,000. Yeah, but your answer will be in years. Remember, it's 10,000 per year. So 10,000 is equals to 1 year. Now, what about 37,000? What about 37,000? And you're going to get it 3.7 years. This one can also be changed into months. Yeah, where we can have 3 years, 8 months. Why am I saying this? It's because there are some questions that will require you maybe to calculate, or maybe it can direct you to provide your answer in years and months, not as a decimal. So in this case, you'll just come 3.7, this is 3 years, but now 0.7 you come and multiply by 12 months and you get it's a 8.4. 8.4, that is 8 months. Yeah, so it will be a 3.7 years or 3 years, 8 months. Is that okay? I guess that is very clear. This is basic. Calculating the payback period for a similar cash flow project is very easy. You just take the initial outlay, the amount that the investment costs, you divide by the annual cash flow. Is that okay? Yeah, that's okay. Now, where we sometimes get some challenges, but it's not also hard, is where we now have irregular cash flows. It's now where we have the irregular cash flows. Where we have irregular cash flows. For instance, for irregular cash flows, I want us to do an illustration on irregular cash flows. I want us to do an illustration on irregular cash flows. Now calculating our payback period in an irregular cash flow. To calculate our payback period for irregular, getting the payback period. If you want to calculate your payback period, first of all, you'll get the number of year before recovery. So the year before recovery plus the remaining amount to recovery, remaining amount. But now this remaining amount will be divided, the remaining amount, you divide it by the cash inflow of the next year, of the subsequent year. So you divide by the cash inflow or the cash flow of subsequent. The cash flow of the subsequent year, of the year after recovery. I guess that is very clear. For you to get the payback period of an irregular cash flow investment, you get the year before recovery plus the remaining amount to recovery. For instance, our project required 1 million. Yeah. And the year before recovery, for instance, we have 950,000. Now what you will use as the remaining amount will be 1 million minus 950,000, which is 50,000. So you'll get the 50,000. That will be your remaining amount to recovery. And now you divide by the cash flow of the subsequent year, of the year after recovery. Can we do an example on the same? I want us to do an example on the same. For better understanding, I want us to do an example on the same. Just know that calculating the IRR for an irregular investment, cash flow investment, you take the year before recovery, you add the remaining amount to recovery, you divided by the cash flow of the subsequent year. So I want us now to look at an illustration. Yeah, for instance, you're told Luanda Magere has invested in a project whose cost is 80,000. You're told that Luanda Magere has invested in a project whose cost, the project cost is, the project cost we are told is 80,000. And the project is expected to generate the following cash flow. Yeah, so let me note down the cash flows that we have. So here we have the year. You can draw the table. We have the year and the cash flows. So we have 5 years. So during the first year, we had a cash flow of 10,000 shillings. The second year, we had a cash flow of 30,000. The third year, we had a cash flow of 15,000. The fourth year, we had a cash flow of 20,000. And the final year, the fifth year, we had a cash flow of 30,000. Now we want to calculate the time it will take to fully recover the amount that was used for investment. How long will it take for us to recover this 80,000? Remember, we are told that our project cost 80,000. So when you find such a question that wants you, remember this one wants you to find the duration it will take, and the duration is calculated through the payback period. Once you just hear of the duration it will take, that is a payback period. This is the only technique that talks of the year, the only technique that will require you to calculate the years it will take, the payback period. So when you get such a question, first of all, what you do, you'll include another column, your third column. Remember, we have the first column that has the year. The second one is talking of the cash flow. And now you'll have to include another column that will look at the cumulative. It will talk of the cumulative cash flows. Now, for the cumulative cash flows, for us to calculate the cumulative cash flows, the cumulative cash flows is just the summations of what we have. But now here, our first cumulative value will be the 10,000 that we have. But during the second year, now you'll take 10,000 plus the next year's cash inflow, which we had is 30,000. So 10 plus 30, we have a 40,000. Now from 40,000, the next year we had a 15. So 40 plus 15, that is 55,000. From 55 plus this one we had 75,000. And finally we have 105,000. Remember, we were told that our project requires 80,000. So what we want to recover is just the 80,000. And when we look at our cumulative values, we have 75,000 and the next value we have is 105,000. So we can't pick the final year. We cannot pick the final year because this is above what we require. We require only 80,000. But when we talk of 105, this is excess. But when we also come back to 75, this is also less. So meaning that our year, the years that will be required to generate this amount is an year between 4 and 5. And for us to find this year, remember we say that to find payback period for an irregular cash flow, you take the period before recovery. The year before recovery, you add the remaining amount to recovery divided by the cash flow of the next year. So like in this case, we can't go for this one, but the year that is very much close to what we require is the year that has 75,000, and that year is 4. So remember, you say that you take the year before plus remaining amount over cash flow of the next year. Cash flow. So in this case, the year before a full recovery, we had a 4. So it will be 4 plus. But now, between 80,000 and 75,000, what we lack, the amount we lack is 5,000. So that will be 5,000. But now we're going to divide it with the cash flow of the next year. So after this year, the next year's cash flow that we had a 30,000. So it will be 4 plus 5 over 30. This is the years that we have. And when you calculate that, you're going to get it's a 4.16667, or you're going to get it's a 4.1667 years. Or similarly, if you convert this into months, they're going to have 4 years and 2 months. 4 years, 2 months. Is that clear? Is the concept okay? Or do you have any questions? I guess to say that the concept is okay. I guess in relation to the same, I'm going to, under payback period, you might also be provided maybe with 2 projects that needs you to give a comparison of the most or of the best project that individual can venture in. You can be given maybe 2 projects. Maybe we have project A and project B, and provided with the cash flows of these specific projects. And now you're told, using payback period, or advise the investor on which project to choose using payback period. In such a situation where you're provided with 2 different investments. For instance, we have investment A and we have investment B. What you'll do in this case, you will do this entire process for investment A. You also come and redo the entire process for investment B. Then you come and make a decision. And decision under payback period is you choose the project that recovers the money within the shortest time possible. So for instance, if project A takes 3 years, while project B, for instance, takes 2 years, 3 months, let's say 2 years, 8 months, then I guess the individual can choose project B over project A. So there are some cases, or in most cases, they just can't give you a project with a single cash flow. Sorry, they can't just give you a single project. In most cases, in examinable sessions, they give you 2 projects, and they tell you to advise the investor on the best project so that he or she can venture in. And in this case, you calculate the payback period of project 1, the same for project B, then you do a comparison. Is that okay? Or any other explanation that you need? Is the concept okay? Because I want to give you another one question with the 2 projects, and I'm going to give you around 10 minutes, 10 to 15, then you give me the answer, and I guess you're going to call it a day. We'll pick from there during the next session. But until you give me the feedback, then the session can come to an end. Is that okay? Are you okay with that? Okay. So for instance, you're told, consider a case of 2 machines for which the following information is provided. Consider a case of 2 machines for which the following information is provided. So I'm going to draw a table. I'm going to draw a table. You're told consider the case of 2 machines for which the following information is provided. So we have the year, we have machine P, and finally we have machine Q. So we have the year, machine P, and machine Q. Then we have year 0, year 1, 2, 3, 4, and 5. And the cash inflows for year 0, here we have 10,000. We just have 10,000. And also the same for machine Q, it has a 10,000. The first year on machine fee has 1,000. So I'll key in the values for machine P first. We have 1,000, 2,000. We have 6,000. We have 7,000. And finally, we have 8,000. So we have 1, 2, 6, 7, 8. Then for machine Q, we have 5,000. The second year is 5,000. Thirdly, we can talk of 1,000. We can also talk of 500. And finally, 500. Meaning the total profitability of machine A, we have, this is 1 plus 2, 3 plus 6, 9, 9 plus 7, 16 plus 8 is 24,000. So this is the profitability. So the profit of year 1 was 1,000, 2,000, 6, 7, 8. And for this one, I guess it's 12,000. Now you are told to advise the investor on the best project that he or she should venture in. I hope you can able to see my board. We have 10,000, 1,000, 2, 6, 7, 8, and we have 10,000, 5,000, 5,000, 1,000, 500, 500. Kindly work on it, then you give me your feedback. You advise the investor on the best machine that he or she should go for. Advise the investor on the best machine that he or she should go for. Hi, Naomi. What did you get? What are you getting? Machine Q. Okay. What duration does it take to recover the income of machine P? What duration did you get? Machine P. Okay, and how about P? Q has 2 years. And what of P? What are you getting as your recovery period for machine P? Three years, 9 months. I guess mine I'm getting as 3.1 for I don't know it's how many months. But yes, you're right. The investor should venture in machine Q because machine Q has a short recovery period. Machine P has a short recovery period. However, whatever I'm getting as a machine P, at machine P, whatever the value I'm getting is kind of different from what you have. Because for me, I have it's 3 years plus 1/7. 3 years plus 1/7. And 1/7 change to years. Because here, for instance, if we go by the cumulative figures, let me just add it here. We have a cumulative figure here, and we also have the cumulative here. So for machine Q, you got it right, because here we will have 5K. This one will have, it will be a 10K. This will be 11. I guess this one we can't really proceed further because we've just recovered the amount that we have, and it's recovered at 2 years. But when we come to machine P, here we will have a 1K. Then this one will be a 3K. 3K, this will be a 9K. 9, this will be 16K. And finally, yeah, this one will be 24K. But now for this one, our machine will be recovered between this period because we need a 10K, right? We need a 10K. And here we have a 9, and the next figure that we have is a 16. So for 9 lies under 3 years. So it will be 3 years plus. The remaining amount between 9 and 10,000, it's 1,000. And the cash inflow of the next year is 700. So 1,000 over 7,000. And we're going to get it 1 over 7 years. And when we convert this 1 over 7 years, I don't think if it will give us 9 months, it will be 1 divided by 7 by 12. Yeah, it's approximately 2 months. So it's the same as 3 years, 2 months. Because I'm getting a 3.71443. I guess maybe just had a slight error. You just had a slight error. But you're right. The investor should focus on machine P because machine Q, because machine Q has the minimal recovery duration. Is that okay? We are not supposed to accumulate from the initial outlay. Yeah, the initial value, this is our initial. Remember, we are not going to include this one because this is what we need before we start accounting for it. So we are not going to use year 0. This one tells us what we want. No wonder you can see it's in brackets because this is a debt. It's like a debt that we have and we need to account for this debt. So this is more like the initial outlay, the amount that you want to recover. So we are not going to include the year 0. Instead, we are going to start accumulating from the first year. We are going to start accumulating from the first year. Is that okay? Yep. Yeah, sure. So you will start accumulating from here. Or similarly, you might decide, because this is a negative, yeah, because this is a negative. Similarly, if you decide to use whatever you're saying, like we start with the initial value here, it's different and it's possible. What you'll have to do, like here we have it's a negative 10 because it's in bracket. Yeah, we can start from here. And now this is a positive. You had negative 10 and you had an addition of 1, meaning you're going to remain with negative 9. So meaning here, yeah, similarly we can go with that format. But now our cumulative values, now here we will have it's a negative 10. The next value will be a negative 9, or let me just put them in brackets. This one will be negative 7. This one will be negative 1. Remember here we've not recovered it yet. Then here we will have a 6. Sorry, this 6 will be a positive now. And this one will be in excess, meaning for us to still recover, it will be here. And the amount remaining for us to recover is the negative 1 that we have. Yeah, it's 1,000. Remember, they're in thousands. Sorry, it's 9K, 7K, 1K. So they're in thousands. So for this one will be the remaining amount for us to fully recover this 10,000 is 1,000 because we can't go for 6. So we will take the 1,000, we divide by the inflow of the next year, which was 7,000. So whichever way, if you start by the initial value, remember the initial value is in negative. Is that point clear? Is that okay? Yes. So yeah, that's it. But in most occasions, I guess just start from here, from the first year's profit. This is the profit we made during the first year. And the profit can be used to recover the amount that you used in developing this project. So you're just going to focus on these profits. Don't include the initial values, the initial outlays that you had. So I guess that's, or do you have any other question? Do you have any question in relation to what we've done? Any question? I guess it's none. I guess that will mark the end of our session today, because if we introduce the other part, the other technique, the accounting rate of return, I believe by the end of the session, we wouldn't have covered anything. So I guess we'll call it a day from there. and we'll pick it there during our next session. And thank you so much for joining. Mercy called me. She told me she might not make it.